Right, morning all. Welcome back to Morning Kappa at 8. Okay, so if you look at the S&P 500, well, it inched up marginally, right, on yesterday's session, as the weekly jobless claims came in steady, coming the market panic sparked by the Wednesday's weak ADP data and reassuring traders that the labor market is uh, bending and not breaking, right? So, however, if you look at the index now, the sentiment was also lifted by the Apple, which rallied after, uh, the street raised its price target, citing the strong iPhone replacement cycle demand on AI, right? Effectively offsetting the weakness in the financial sector yesterday ahead of the earnings season. So expect the volatile session for today, right? As the market react to the NFP report. Well, at this juncture, resistance remains kept at the 6950 uh, resistance level, right? So yeah, if you look at the China A50 futures, were dropped around about 1% yesterday. Okay, as the financial names like ICBC, um, China Construction Bank, right, was sold off on rumors that the major local government financing vehicle missed the bond payment, which also reigniting the fears about the banking exposure in the local debt, right? So sentiment was further, I think, further soured by the European announcement in investigation into the wind turbine manufacturer for the unfair subsidies. So I think today, well, at least the futures to trade lower, driven by the sentiment in the China market, right? So if you look at the WTI crude oil futures, right? So well, it inched up yesterday to close at 5839 or 58.4 dollar on Thursday session as the shutdown of the Sharara oil field, creating an immediate supply gap that I think temporarily offset the fears for the Venezuela flood. So I think sentiment was further supported by the China issuing the first batch of crude import quotas, um, with I think volume coming in higher than expected, signaling the independent refiners are preparing to bottom fish and soak up the cheap barrels. So at this juncture, we keep our trading bias, negative trading bias unchanged, and we now expect the price to reject this 50-day moving average line and break the consolidation zone here, aiming for the $55 level. Right, so if you look at the Malaysian market, well, the KLCI yesterday declined to close at 1669.57 on Thursday, uh, dragged down by the sell-off across the sector within the board, right, which also tracked the weakness in the US names. So if we're talking about the big caps, the big cap names, I mean, profit taking also hit the YTL. Tenaga, right, erasing yesterday's late gain as the foreign funds turned net sellers to reduce the risk exposure ahead of the NFP report today. So for the FKLI, uh, for those who are trading FKLI, right, expect the FKLI to trade cautiously, range bound today. I think the market will likely to be neutral until the job data release tonight. I think now 1650 is acting as a critical support with 1007 resistance is in, right? So in terms of sector performance day to day, well, is showing that the property sector is the top gainer among all the sector. So if we're looking at some of I mean, to trade, right? I mean, we have some of the opportunities to do intraday trade. So we may take a look as well. I think we have some names here, and maybe if I can point out, maybe we have Syntax that we have recently published in our trading stocks report. So for today, in terms of our trading stocks, Malaysia trading stocks, right? We have SOP, Sarawak Oil Palm. So I think the stock is in its pending breakout formation at the 3.85 level on a strong volume. So with that, we expect the momentum to remain bullish and stock able to climb further to test the next resistance at 4 ringgit. Followed by 4 ringgit and 15 cent second resistance level. So now if the stock clear below 3 ringgit 70 cents support, I think this could shift to the bearish structure. Right. Also next we have Coraza Integrated Technology. So the stock is experiencing a breakout at this 60 cent level. So if the stock to remain bullish and the bullish momentum to remain to strengthen, right? We're expecting that the price to reach 65 cent in the coming session, together with the high volume and second resistance is at 70 cents right now. And keep an eye at the 55 cent level for any attempt of reversal. So today we have one pending breakout stock for SOP and breakout stock for Raza. Okay, and for the FCPO, well, yesterday it inched up slightly to close at 4043 ringgit on Thursday session, right? Tracking on the rally of the soybean oil driven by the news whether the forecast predicting the crop stress in Brazil, which could also lower the global veg oil supply. So I think trading volume was thinner as some of the participants engaged in the position, I would say replacement, right? So I think expect the price to remain trap range bound between 3,900, also the resistance of 4,100 level for today's range, right? And traders are unlikely to make a big move until they officially see the MPOB numbers probably next week. Right, so I think that's all I have for today. Thanks everyone. Thanks for listening. Happy trading, and see you next week. I pass to the next presenter. Thanks.
Hi, thanks, Aiman. Good morning, everyone. So today I'll be presenting about strategy for Plantation going into 2026 on behalf of Li Ling. So in 2025, spot CPO prices have been volatile. You can say very volatile, and falling nearly 20% from the January 2025 peak to around current levels to 3,900 to 4,000 per ton. Mainly driven by high Malaysian stocks and a narrow CPO soybean oil spread that weakened the demand. As the spread between CPO and soybean oil widened again from mid-October, so CPO regained competitiveness, imports rebounded, and palm oil stocks level across key importing countries are now back at comfortable levels. So looking into 2026, beyond the usual seasonal patterns, we highlight there will be 4 key factors that could influence CPO prices in the near to medium-term future. So first, La Nina, which has been in place since mid-December 2025, even though it's a weak one. So far, there's been no major impact in South America, with Brazil's 2025-2026 planting completed, while Argentina has planted 82% of its estimated area as at December 2025, up 64% from last year. So that's it. The coming weeks, it will be critical in determining whether weather conditions eventually affect the crop output or not. Second factors, it will be focusing on Indonesia's B15 mandate, which we think the outlook remains positive because the government continues to signal the implementations in 2026. And most likely, it will be on the second half of the year of 2026. So if B40 is fully met in 2025, biodiesel output would rise 12% year on year, utilizing around 13.5 million tons of CPO. So a move to B50 from B40 could lift CPO usage to 17 to 18 million tons in 2026, although our best case assumes that it will be rolled out in the second half of the year. So key risks remain funding and capacity expansions, but based on our current spreads, the biodiesel levy may need to rise significantly, which historically triggers a spike in global CPO prices, which benefit Malaysian planters more than Indonesian planters. The third one, on the China-US soybean agreement, the implementation risks remain. Under the October 2025 Trump-Xi Jinping deal, China committed to buy 12 million tons of US soybeans by end of 2025, but purchases so far are only around 7 to 8 million tons. So while US exports to China have resumed, higher US prices currently at 12% to South American beans. So it could divert the demand from the rest of the world back to South America. So this may leave US soybean stocks elevated in 2026, which stock-to-usage ratio at a multi-year high currently, and potentially pressuring soybean oil prices and reducing CPO's relative competitiveness. And the fourth, the last factors that could affect the CPO price next year is the US biofuel policy. There is a growing risk of implementation delay because the US had proposed raising biofuel blending volumes from 2026, which would have lifted domestic soybean oil demand by over 10%. But however, the EPA is now considering delaying the rollout amid the pressure from the refiners' concerns about the high costs and the tighter fuel supplies. So if it's delayed to 2027 or 2028, the US soybean oil balance will be less tight than expected, pushing global stock-to-usage ratios higher. So this will likely cap soybean oil prices and negatively impact the CPO's relative competitiveness. So overall, we expect 2026 to be more balanced year fundamentally. Our best case assumes that there's no major weather disruptions. Indonesia B15 mandate implemented from the second half of the year, adding around 2 million tons of incremental pump demand and a gradual ramp up in China's US soybeans import. We also assumes that there is no delay to US biofuel policy and there is no major geopolitical shocks that would disrupt the vegetable oil supply and the demand and key inputs such as fertilizers. So we maintain a neutral stance on the plantation sector with unchanged CPO price assumptions. While prices are likely to remain amid the ongoing geopolitical uncertainty, we expect the average CPO prices to trend slightly lower year on year in 2026. Year-to-date 2025 spot prices of around 4,300 per ton remain broadly in line with our assumptions. As such, we remain our CPO forecast for 2026 to be around 4,250 per ton and 4,100 ringgit per ton for 2027. Our topics for this plantation sector are Johor Plantation Group, Sarawak Oil Palms, IOI Corp, and London Sumatra Indonesia as the value place, while SD Guthrie and First Resources will be our situational place. That's all from us this week. Thank you all for joining the call and see you all next week. Thank you.